New year, new statements. It's the first week of January 2026. In a small Ohio kitchen, Margaret, a 72-year-old widow, pulls out a chair, wraps her hands around a coffee mug, and opens the newest line on her bank statement. She has been waiting 12 months for this deposit. She circled the date, told her sister on the phone, and counted on the adjustment to finally give her breathing room. In her head, it meant the heating bill, the rising co-pays, and a little cushion for the winter. She thought January would feel like relief, not confusion after all these months. Every broadcaster repeated the same promise. Social Security would deliver a cost of living increase, 2.8%. Margaret even did the math on scratch paper. She expected about $56 extra each month, and she already had a job for every bit of it. The furnace has been running more, the grocery total keeps creeping upward, the eggs, the bread, the blood pressure medication, everything costs more than it used to. Her fingers shake as she unlocks the banking app and her stomach sinks. The raise is there, but it's nowhere near what she imagined, not even close. She leans in, squints, refreshes the screen, then pulls December's statement to compare the two entries side by side. That's when she notices an unopened envelope on the counter, stamped Medicare. She almost threw it out, assuming it was a flyer. It isn't. Her Part B premium is higher, her Part D coverage has changed, her deductible is up, and in one quiet moment, the $56 raise stops being $56. A heavy dread rolls through her. She whispers, "Where did my raise go?" If you opened your January deposit and felt that same hollow drop, hear this. You are not the only one. At this exact moment, from coast to coast, millions of older Americans are asking that identical question. And the real explanation is bigger and more urgent than any quick TV segment is willing to admit. I'm a senior policy analyst, and most of my working life has been spent turning dense federal rules into plain guidance people can actually act on. In this video, I'm going to walk with you, step by step, through what really happened to that 2026 raise. We'll use confirmed numbers straight from the Social Security Administration and from Medicare.gov. We'll also uncover a little-known legal protection hidden in the statute that many retirees have never heard explained clearly. And before we finish, you'll have 3 specific tasks to complete this month to protect every dollar you earned. I'll point out where the headlines simplify the story, what Medicare changed at the same time, and how those pieces collide inside your monthly deposit. Nothing here is speculation. It's the published policy for 2026 only. But please do not leave before the final section. There is one tiny, easy-to-miss mistake that a huge number of seniors are making right now this week without realizing it. That single slip can pull almost $1,000 out of your pocket each year, and in some cases, close to $6,000 per year. Before we're done, I'll show you exactly what it looks like and how to avoid it. So top off your coffee. Get comfortable in that chair. We're going to work through this together, line by line. Now meet Robert. Robert is 67. 2 years ago, he retired from a long career teaching high school math in Pennsylvania. When it comes to money, he is careful to the point of ritual. He still balances his checkbook every month the same way his dad taught him. He opens every envelope, reads every notice, and pays bills the day they show up. By any normal measure, Robert is the picture of a responsible retiree. In 2024, Robert made a decision he thought was smart. His planner suggested converting a portion of his traditional IRA to a Roth IRA. One move, done once. Robert paid the tax that year, swallowed the hit, and felt like he had bought himself a simpler retirement. Then, November 2025 arrived, and a letter from the Social Security Administration showed up in his mailbox. It said that, based on his 2024 income, his Medicare Part B premium for 2026 would not be the standard $22.90. Instead, it would be $208,410 each month for 12 straight months. Robert read it twice. He assumed it had to be wrong. His 2025 income was modest, nothing but Social Security and a pension, but the letter was clear. Medicare looks back 2 years at your tax return. And in 2024, that one Roth conversion pushed his income exactly $1,000 over the cutoff. Just $1,000 past the line. That small overage triggered almost $1,000 in extra premiums across the year. He had budgeted his retirement around the normal premium, so that jump felt like a penalty. One line on a tax return was now rewriting his monthly cash flow completely. Robert called Social Security. He waited on hold for 2 long hours. When someone finally answered, the representative told him something that changed everything. There was a specific form he could file. It is called SSA.gov, but time mattered. He had to prove a qualifying life-changing event, and he had to do it within 60 days of the notice. Robert came dangerously close to missing that deadline. He nearly paid that surcharge from January through December, but he didn't. And by the end of this video, you'll know exactly how he avoided it. With that in mind, let's break down what is actually happening inside your 2026 Social Security payment, because most headlines are telling only the simplest version. On October 24, 2025, the Social Security Administration announced the 2026 cost of living adjustment. The number, 2.8%. That increase affects about 71 million people who receive Social Security retirement, disability, or SSI. The average retirement benefit moves from $2,015 a month to $2,071 a month, which is roughly a $56 increase. On paper, that sounds comforting. That's the part the evening news repeated. But here is the missing half of the story. That same day, Medicare released its own update, confirming that the standard Part B premium for 2026 would be $22.90 per month. In 2025, the standard premium was $185. That is a $17.90 jump every month, nearly a 10% surge in a single year. So do the kitchen table math. Start with the $56 COLA bump. Subtract $17.90 for Part B. Your raise becomes about $3,810 in usable money, and that's before any other adjustments touch you. That leftover amount is what you can use for heat, food, and transportation. It is the money that remains after Medicare reaches in first. And remember, this calculation assumes you pay only the standard Part B premium. If you are paying an income-related surcharge, the subtraction is bigger. If you are newly enrolled, the math can look different. We're staying with the case for now, and there's more. The Part B deductible, the amount you pay before Medicare starts covering many services, rises from $257 in 2025 to $283 in 2026, another jump of about 10%. The Part A hospital deductible is now $1,536 per benefit period. If a hospital stay goes beyond 60 days, you owe $434 per day. If it passes 90 days, the daily amount becomes $868. Your Part D prescription coverage changes too. The good news, there is now a $2,100 annual cap on out-of-pocket drug costs. The catch? The Part D deductible can be as high as $615 before that cap even begins to matter. When you add all of this together, the picture looks nothing like the headline. For the typical retiree, the $56 increase is essentially consumed before you even reach the pharmacy counter. And for anyone receiving below-average benefits, the Medicare increase eats an even bigger share. Some people will see almost no raise at all. But there is one major detail the headlines almost never include, a legal safeguard that can protect your check. It's called the Hold Harmless provision. You'll find it in Section 1839F of the Social Security Act, and its job is simple. Your net Social Security payment is not supposed to go down from one year to the next just because Medicare premiums rose. About 70% of Medicare beneficiaries are covered by this rule. If you are in that protected group and the Part B increase would otherwise reduce your monthly deposit, the government must charge you a smaller Part B premium, not the full $20.90, something lower that keeps your payment steady. But, and this matters, Hold Harmless is not universal. It does not apply if 2026 is your first year enrolling in Medicare Part B. It does not apply if you pay Medicare directly instead of having premiums withheld from your Social Security benefit. It does not apply if you are classified as a higher income beneficiary paying IRMAA charges. And it does not apply if you have both Medicare and Medicaid and your state pays the premium on your behalf. So your first job today is to figure out which group you are in. If you are supposed to be protected, you could be paying more than necessary without realizing it. And if you are not protected, you need to know why and what options you still have. The key is knowing your status before you assume your deposit is correct. Now let's talk about where the biggest hit often lands and where many retirees don't realize they have any recourse. IRMAA is short for Income-Related Monthly Adjustment Amount. It's an extra surcharge added on top of your Medicare premium based on income. Here's the part that confuses everyone. The IRMAA surcharge you pay in 2026 is tied to your 2024 tax return, not your most recent year. but 2 years back. So if you sold a house in 2024, did a Roth conversion in 2024, took a large IRA distribution in 2024, received an inheritance or settlement, or realized a big investment gain, that one-time event can be raising your Medicare costs right now in 2026. And IRMAA doesn't ramp up gently. It's a cliff. If your 2024 income was even $1 above $109,000 for a single filer or $1 above $218,000 on a joint return, your Part B premium jumps from $22.90 all the way to $284.10. That is about $974 more per year for each spouse, plus an added $14.50 per month attached to Part D. The higher tiers are worse. The next bracket is $45.80 per month. After that comes $527.50, then $64,920. At the very top, it reaches $689.90 every month. That works out to around $7,000 a year in Medicare premiums for one person. For married couples, both spouses get hit with the surcharge. So one unusually high income year can drain a household by many thousands of dollars over the course of 2026. It's exactly why people get blindsided after a one-time move, like a Roth conversion. The bill shows up later, when the money is already spent again. So what do you do with this? Where do you push back? Listen closely, because the next part is practical. I'm going to give you 3 specific moves. Grab a pen and pause the video if you need to. Step 1. Find the envelope Social Security mailed you in November or December 2025, the notice that lists your Part B premium for 2026. Do not throw it away. Do not assume the figure is accurate. Read it. If the monthly amount shown is higher than $20.90, you are being charged IRMAA, and you need to know that now, not in July. Step 2. If you have had a qualifying life-changing event since 2024, retirement, stopping work, reduced hours, the death of a spouse, marriage, divorce, loss of a pension, rental income drying up, or an employer settlement, you have a legal right to challenge that surcharge. The tool is Form SSA 44. The form is free. You can download it from SSA.gov or pick up a paper copy at your local Social Security office. And you must submit it within 60 days of receiving the IRMAA notice. Wait too long, and you may lose the ability to appeal for the entire year. That 60-day window is the trap. Put it on your calendar, gather proof, and send it certified if you can, so you have a receipt later too. Step 3. Verify the numbers using official sources, not social media and not rumors. Go to SSA.gov and check your benefit amount and exactly what is being withheld for premiums. Then go to Medicare.gov and confirm the standard Part B premium, the deductible, and the details of your coverage. If something doesn't match, you can request what the government calls a new initial determination. That is your legal right when the IRS income figure they used was wrong, later corrected, or pulled from a return that has been amended. One more important point. If your income is lower than expected, you may qualify for help paying Medicare costs. There are Medicare savings programs, QMB, SLMBB, QI, and QDWI that can pay your Part B premium and can also help with deductibles and coinsurance. There is also the Extra Help Program, sometimes called the Low Income Subsidy, which reduces Part D drug expenses. Millions of older Americans qualify and never apply. If money is tight, don't leave that help on the table. These programs are administered through your state Medicaid office or local assistance agencies, and the applications can be annoying, but the savings can be month after month. Before we finish, remember I promised to point out the single mistake that is costing people serious money right now. Here it is. Assuming Hold Harmless turns on automatically and stays forever. Neither assumption is safe. If you ever stop having Medicare premiums deducted from your Social Security payment and instead start paying Medicare directly, maybe because you think it gives you control, maybe because someone told you it was cleaner, your Hold Harmless protection can disappear, at least until you switch back. And if you delay claiming Social Security but you enroll in Medicare at 65, you are not protected either. Hold Harmless only applies when your Part B premium is being withheld from your Social Security benefit. So pull up your January 2026 statement and look carefully. Confirm that Medicare is being taken out of your deposit. Confirm that your net payment is getting the protection the law requires. If anything is confusing, call Social Security at 1-800-772-1213 and ask directly. And don't accept a vague answer. Request the explanation in writing. Write down the agent's name, the date, and what they tell you, because documentation matters if you need to appeal later and keep the letter with tax records. One last thought as you head back into your day: the rules change, the dollar amounts change, and the income thresholds change. The government is not going to call you to double check that you noticed. Instead, you'll get one letter in the mail, printed in tiny text. If you miss it or misunderstand it, you can end up paying for that slip every month for the rest of the year. And please don't rely on YouTube notifications as your only alert system. The platform can change its algorithm overnight. The next update might never show up on your home screen, and you could miss an important warning. If you want to stay ahead, treat your benefits like a household bill. Check statements, open notices, and keep a folder for Medicare and Social Security letters. 10 minutes of attention now can prevent a full year of surprise premiums later. So here's what I'm asking you to do. Bookmark SSA.gov. Bookmark Medicare.gov. Sign up for the official AARP email alerts so you get notices directly. And if this breakdown helped you, subscribe here and turn on notifications so the next policy change gets translated into plain English, without panic and without politics. Also, share this video with one person you care about: a neighbor, a sister, your spouse, someone from your church, anyone who depends on Social Security. Because somewhere right now, someone is staring at that January deposit and wondering where the raise went. You might be the person who helps them understand what happened and what to do next. Thanks for watching and taking this. Take care of yourself, protect your benefits, share this with someone who needs it, and I'll see you in the update.